I'd like to take this opportunity to discuss with you what we might call deregulation phase 2. It has to do with the safety net that has to be in place in a deregulated environment. Credit unions have been deregulating over the past several years, but in the last 2 years it has been accelerated to a great extent, and I think it's very successfully so. But within this last 2 years, I think we also realized that the safety net or share insurance that must be in place in a deregulated environment was really not there. With this in mind, we bit the bullet 2 years ago and said we're going to do something about it. We tried to raise the equity share of your insurance fund to 1% of insured shares with extra premiums. 2 years ago it was 1/18 of 1%. Last year it was 1/12 of 1%. But in view of the accelerated rate of growth, it became very apparent that this technique might well fall short of its mark. And at the same time, many credit union managers were saying there must be a better way. It's very difficult paying these extra premiums. What other approach can we take? One of the ideas that has come forth to answer this question has been the suggestion that maybe credit unions should in fact capitalize their own fund. With this in mind, Senator Garn and the House Banking Committee have received legislation that would do just that. I'd like to discuss with you the 5 major points of this proposed legislation. First of all, credit unions would be asked to deposit and maintain a deposit of 1% of insured shares. The fund's operating level would be set at 1.3%. That is, the 0.3% of equity that's now there and the 1% that they would deposit. The 1% would be refundable. Anytime a credit union would voluntarily liquidate or choose to go to some other share insurer, they would receive a full rebate of their 1% deposit. The law would also state that the operating level of 1.3%, should it be surpassed, would require this agency to refund to credit unions their premium in full. And should the operating fund continue to be above 1.3%, after the refund of premium, there would be a dividend paid. This would be in the law. It would not be discretionary. These are the main points. I'd like Chip Filson to take a few moments now to discuss with you the arithmetic of why we feel this is a better way to fund your insurance fund.
The insurance plan that Ed just referred to makes sense because we believe it will cost each credit union less than the current plan that's required under law. Let's take an example of $1 million credit union to see why this should be the case. Assume, for example, the credit union has $1 million in insured shares. Under the current situation, the credit union pays a minimum premium of 1/12 of 1%, or $833, and a maximum premium, if there's a double assessment, of $1,667. This is an expense to the credit union. And even after doing this, year after year after year, there is no evidence that the equity in the fund will increase anywhere near the 1% level that is the board's goal. Whether or not that occurs, of course, depends on credit union share growth. But even assuming a relatively low level of share growth, the fund's equity would be nowhere near 1% if double premiums were assessed for each of the next 5 to 10 years. Now, under the proposed plan, let's take a look at how the expenses would be absorbed by the credit union. Again, assume we have a $1 million credit union. There are 2 expenses involved. The first is the premium, 1/12 of 1%, or the same $833. Secondly, however, is the opportunity cost on the 1% deposit. In this case, $10,000 is the deposit, and the opportunity cost, as you can see on the chart, is approximately $975. However, under the proposed plan, there would be a rebate in full of the premium, and in years in which there are normal operating expenses, there would also be a dividend for the fund. That dividend should substantially reduce the opportunity cost so that this plan would be less expensive than the current law now requires. What confidence do we have that we can not only rebate in full the premium, but probably pay a dividend in years of normal operating losses? Now let's take a look at some projections using the current amount of insured shares. If the fund had 1.3% on deposit right now, that is 1% of all insured shares from insured credit unions and the 0.3% of equity, this would give the fund sufficient earnings to pay all overhead fixed expense, the increase in equity required by credit union share growth, plus rebate in full the premium each year. Now the question comes up, would the funds that were left over after those expenses have been taken care of be sufficient to pay all the financial costs of the fund for merger, liquidation, and other assistance, as well as possibly a dividend? Let's take a look at a projection that shows what might occur. Let's assume that for the next 5 years, that credit union shares grow at a 25% rate each year. As you can see on the graph, this shows that the amount left over after taking care of all those expenses in order to meet our financial cost and possibly pay a dividend would range from a low of $30 million in the first year to a high of $87 million in the 5th year. Well, is that going to be enough? Will we have enough to meet our financial cost and pay a dividend? In order to look at that issue, we have to look at what's happened in our financial cost for the last 5 years. The second graph shows the financial cost in the funds from fiscal years 1979 through fiscal year 1983. Now, these financial costs have averaged $30 million a year for the last 5 years. However, in 1982 and 83, we had a special provision that added to these normal costs in order to bring the fund's financial statements into a full accrual method of accounting. Even adding in these special provisions for the last 2 years indicate that our average cost would be $46 million for the 5 years. Now let's go back to the first chart a second and see what the outcomes would be if a 25% growth rate is a little optimistic. Let's, for example, take 2 other outcomes, a 15% per annum rate of growth in credit union shares and a 5% growth rate in credit union shares. As you can see by the gray bars on the chart, the amount of money available to cover financial costs at a 15% rate of growth ranges from a low of $54 million in the first year to a high of $101 million in the 5th year of the fund. And at a 5% rate of growth only, the funds that would be available would be $77 million in the first year to a high of $96 million in the 5th year. So as we project out our earnings using different assumptions about credit union growth, we can state with pretty much certainty that there would not only be a full premium rebate, but that we would also be able to cover our financial costs and in a majority of instances also be able to pay a dividend in full. That's why we believe this plan should be less costly to credit unions in addition to the other advantages of having a fully funded insurance fund right now. Now recently we've been on the road speaking to several credit union meetings, and there's been a number of questions that have been asked of myself and Bucky and other members of the staff here. And we'd like to share with you some of the questions and answers that have come up in those meetings. Bucky, I might start out with a question that I think you had in a recent meeting about whether the 1% was a one-shot deal or whether it was a continuing requirement.
Yeah, I think the credit unions ought to be aware that initially, obviously, they would simply deposit 1% of their assets at the time. However, it would be a continuing requirement that on a date certain, presumably the end of the year or the first of the year, the credit unions would send an amount in to bring that back up to 1% if it fell below due to credit union growth, or that they would in fact get a refund if for some reason the credit union shrunk in size and they now had more than 1% on deposit. So it's a continuing requirement.
Let me just correct one word you used. You used the word asset. It would be 1% of insured shares.
Insured shares, you're right.
I know a question you got asked that I thought was kind of interesting is why, if you think you can pay a premium every year and rebate it in full at the end of 12 months, why send it in at all?
Well, the idea is simple. We should have the money so that it's on deposit, first of all, so we can earn on it, but second of all, so that if there is a bad experience in that year, we don't have to go out with an emergency collection. That's the way the other funds work, and we think it's the proper way to work. While we fully expect to refund the entire premium every year, for those years where that wouldn't be possible, if any come along. We would have the money for the emergency.
Yeah, it's the credit union's advantage. They will expense the premium instead of getting hit with a surprise at the end of the year or the beginning of next year.
That's right.
Another question that came up is, how did we arrive at 1.3%? Why not 1%? Why not some higher figure? What's magic about 1.3?
There's no magic about it. The answer I've given, and I think is straightforward, is we have the 0.3.
Right.
The 1% seems to make sense. When you add the two together, it's 1.3. It seemed like the easiest way, the simplest way to do it, and still arrive at a figure that hopefully everybody's comfortable with.
Well, it lets us do this right now, plus lets us be fully capitalized right now. But it also, as you use the projections, that appears to be the amount of capital that's going to be necessary to have a reasonable certainty that we can cover our financial costs plus pay a dividend unless we just have a catastrophic year.
The two things came together very nicely.
Bucky, one of the questions that I've gotten in writing has had to do with the issue of whether it's really consistent with deregulation to send all this money to Washington. I've had some credit unions outright say, hey, I don't feel comfortable sending 1% to Washington. Why couldn't we leave it in our credit union and just designate 1% of our reserves as assignable to the fund? Or even better yet, if that's not good enough for you, I will assign 1% of my insured shares that I keep on deposit at my corporate credit union to the fund so you could have them on call. Why do we have to send it to Washington?
Well, I think there's a couple of reasons. The first is it's obviously the best way we know of being sure that it's done. Obviously, we can't monitor the 11,000 credit unions every day to see that they have, in fact, moved it over to a reserve in their own credit union, if that's the suggestion.
16,000 insured credit unions.
16,000 insured credit unions, that's right. The other thing is, quite simply for purposes of what's going on in this city, look at the other funds, some of the talk that you're aware of that's gone on around here in the last 2 years about possible merging of the funds or talking about the relative health of the funds. We need it here so that we can demonstrate, and the credit union movement can demonstrate to the lawmakers that they are prepared to fully fund it. And the second thing, quite simply, is the beauty of the plan we've come up with, I think, and the reason why it works is we have the money. We do clearly keep the earnings on it to the extent that we need them to pay expenses, liquidation, merger expenses, and our operating expenses. We couldn't do that if the credit unions just kept it in their own backyard.
Yeah, if we don't get the earnings on the 1%, all of those projections I just gave don't work.
That's correct.
We just have the income we've got right now, and right now isn't satisfactory. Right now, we're not going to build equity up at all if you assume a very high rate of credit union growth, and very, very slowly if we have a low rate of credit union growth.
And the money that we're talking about is something that the credit unions now don't have in their own credit union anyway. They have it on deposit somewhere else. We're looking at the liquidity funds that they have, you know, money that's not out in loans to their members. It's invested somewhere else. I'm saying consider it an investment in the NCUA Share Insurance Fund that will pay you back in terms of a premium rebate on the insurance fund and not more than probably a dividend. So that think of it as an investment, and then why shouldn't we have it as opposed to someone else when it will in reality earn as much for you as it will anywhere else?
I think there's been generally a consensus that the people are willing to support a 1% or an increase of equity. But occasionally the question gets raised, isn't there a trade-off? Can't you give us something in return for this? For example, why not increase the limit on investment in fixed assets or the current limits on QSO or something else? Is there a trade-off that you think is necessary?
Yes, I think there is a trade-off, and I think we've already traded off. I think that, as the chairman pointed out in his introduction, credit unions have been deregulated in advance of the other financial institutions regulated by the federal government. The trade-off for that deregulation is the improved safety and soundness of our share insurance fund. So I think we've shown a lot of good faith by giving the deregulation, accomplishing that first, and now saying, you know, along with the responsibility and the authority to do what you want, operationally, you also have the responsibility to fund the insurance fund, and we're saying you've gotten up front the benefit, and now we think that the fund ought to be done, and we think we've done it in a way that should be, you know, no burden to any credit union.
Well, I think there's a kind of implicit assumption in that question about a trade-off that somehow credit unions should be allowed to go out and engage in a little riskier activity now that the fund's stronger. And I would strongly resist any element that there's a connotation here. Now you can go out and do things you wouldn't otherwise have done. I think that would not be a wise move at all.
Clearly that's not the intent of deregulation, but the fact of the matter is there are a broader range of opportunities for credit unions, some of which they're unfamiliar with, some of which, through no fault of their own, may turn out to be risky investments. And this is simply the safety net that we think ought to be in place. And in fact, the credit unions have indicated they want to have in place. They just found the two-payment system, the two-premium system, too burdensome. We think this plan will take care of those concerns while fully funding the insurance fund.
Another variation of this theme that's been proposed was, if you're going to rebate or pay a dividend, why not incorporate in that repayment some type of risk rating? For example, if a credit union has this % of capital in the credit union, or if it has some other criteria that we generally deem to be a stronger credit union, why not rebate them in full and either not rebate anything at all to the others, or try to reward those that appear to be better managed?
Yeah, that's a very often asked question, as you know. The first wrinkle to it is, okay, we are very well reserved, very well run. Why should we continue to pay when the other credit unions who are, quote, riskier, don't pay any more than we do? And the answer to that's pretty simple. Credit unions are unique, as we all know. We're not talking about necessarily the same kind of risk you're talking about with a bank or savings and loan. And I think if you reflect on it, the sponsoring company of a credit union can move south tomorrow, can be forced to close for reasons that have absolutely nothing to do with the quality of the operation of that credit union. And so you cannot rate that risk, because the risk may be tied to something totally external from the credit union, and that's not true in the other types of institutions. On the other one, and I was asked this question last week, you have credit unions that are Code 4 and Code 5, some are insolvent, have 208 accounts. Clearly we've identified a risk there, even though we may not be able to with some other ones. Why don't we make those risky ones pay more? The question is simple. You end up taking the money out of your left pocket and putting it in your right pocket because they're already in trouble. We've got a guarantee or maybe some cash assistance in there, or they're on the brink. A double payment or a higher premium is going to make them insolvent, or we're just going to be taking out of one side of the insurance fund and paying it to the other, and it just doesn't make any sense.
That's right. I think that you pointed out several points. One, is very difficult to assess risk. And in doing so, sooner or later, I think you're going to begin to have to make judgments about activities that really re-inject rulemaking back into credit union business decisions, apart from the external factors of risk. And I think it's very difficult to see any reasonable income that the very small minority of credit unions that are having severe problems could ever contribute that would offset significantly the 70 to 80% of the credit unions that are coded Code 1s and 2s. I just don't think it's a doable proposition that's going to save the vast majority of credit unions any money at all.
I would agree. One of the other questions I got was, couldn't the credit union earn more on this 1% if they put it out in loans to their members? And while we're talking about what we could earn on the 1% if we had it all here, and I think you just have to answer that question by saying, while that's possible, loans by definition in the Federal Credit Union Act are risk assets, and yeah, quite clearly we think that we can invest it as prudently and as effectively as any of the others, and I get back to the same issue that we have the money. And if any of you are thinking of that as of a reason, we have thought about it, and we still think that it's in everyone's best interest that we manage those funds.
Let's get back to the heart of something you and I talked about several months ago before we even thought that legislation was going to be required this soon, and that is whether or not we could have credibility if the deposit was withdrawable. What are the advantages of making the deposit withdrawable, and don't you run the risk at some point in the future of having a potential run on the fund if everybody could come in and get out?
Well, I had a lot of questions about that in the beginning, and I've satisfied myself for a lot of reasons. First of all, it is a uniquely credit union solution to the problem of undercapitalization of the fund. I was surprised and quite pleased, honestly, that when we ran this idea past both the House Banking Committee and the Senate Banking Committee, that they had no problem with it as a concept. They didn't think that it was, mirrors or tricks or anything like that. As you pointed out earlier, we have the use of the money. It acts like equity. We can use it as equity if we have to. The reason why it's refundable in a voluntary liquidation or in a conversion of insurance is credit unions have the only really extensive viable dual chartering system and dual insuring system. credit unions have another place to go to get insurance, by and large. The other types of financial institutions, with some very isolated exceptions, do not. So we think that it's proper to give the credit unions that opportunity. It will give them the reassurance that if the agency or the government ever becomes oppressive, they can get out, and it keeps us honest, keeps us on our toes. We know there's competition out there, and we have to do as good a job as any other insurer if we're going to keep their funds.
And I think if we're not doing a good job, the implicit nature of the question is, well, if you legislate it so people can't leave, somehow that's going to be better, and I don't buy that at all.
No, absolutely not. What we don't want to be in a position of forcing anyone into our agency or our fund. And if we don't force them, we'll know everybody's here because they want to be, and that will keep us on our toes.
And I think the withdrawable feature is just one of 2 or 3 characteristics of this legislation that do provide a balance. One is the mandatory rebate of any income in excess of the 1.3% normal operating level. And secondly, the statute explicitly sets 1.3 as the maximum capital in the fund. So in addition to the withdrawable feature, I think credit unions have some legislative protection that doesn't exist right now, even with this level of capital.
There are some people that were afraid that we would, even though we had the authority, that we would not rebate premium or not rebate or refund dividend, if you will. And this legislation mandates that. The agency will have no choice. Whenever it's fully funded, it must rebate anything it has over and above that back to the credit unions that earned it, in effect.
And the withdrawable feature also, I think, provides flexibility for the future. No one knows how many alternatives are going to be out there. No one knows what the future holds with certainty. And I think having that withdrawable feature gives credit unions a check and balance for their fund in the climates and options that could be put on the table tomorrow. I think a final question that has come up almost every conference I've been at is, what's the urgency? Why now? Do you really think this plan is going to make a difference if we do something now as opposed to waiting 2 or 3 years and, give the current system a little longer time to run? Were these last 5 years really representative of the cost you should be incurring if we have a good recovery and so on? What is the urgency?
Well, I'd say if there's an urgency, it's the fact that it's being talked about, discussed. We had to file insurance reports, as did the other agencies under the Garn-St. Germain legislation. It's been discussed by the General Accounting Office. It's being discussed at the Vice President's task group. And we're in a less than, great posturing position because the fund is perceived to be weak in that it's far less than 1% and the others are at or above 1%. The other thing is, why not now? We have the opportunity. Credit unions are liquid. I think we've come up with a plan that will show them that it, in effect, is not going to cost them any money. And everybody looks at me and says, "Don't give me that malarkey. It's not going to cost us any money." And I challenge them to go back and work the figures. They've paid a full premium and an additional 1/18 of 1% 2 years ago. They paid 2 full premiums last year. If they were to look at this plan, work the numbers for their credit union, compare them to what they actually paid in the last 2 years and what they can expect under this plan, they will find that it's cheaper, easier, faster, cleaner, and it's just a better plan. And in view of the risk that might be out there of losing the separate fund and the opportunity that presents itself at virtually no cost to the credit unions, there will never be a better time than this to do it.
I think that's the bottom line. It is a better plan.
Well, there you have it. You've heard the facts and figures that seem to support the idea that this new idea is, in fact, a better way for credit unions to fund their insurance. We'd like you to take the time to run your numbers against this experience and get back to us. This is a unique credit union technique for solving problems. We'd like to hear from you. It is your insurance fund.